Today I want to tell you about two couples who did everything right. Stan and Sue and Ron and Rita. They're the same age. Both couples just turned 63 and just retired. They earned about the same over their careers. They were both very disciplined savers throughout their lives, and they each walk into retirement with the exact same nest egg. $1.2 million sitting in a traditional 401k. Same house, paid off. Same Social Security. Same plans to spend about the same amount. On paper, these two couples are identical, but over the next dozen years, one of them is going to hand the IRS tens of thousands of dollars more than the other. Not because they earned more, and not even because they invested better, but because of one single difference in how they handled the years right in front of them. Here's the cruel part, and it's the reason I wanted to make this video. The trap I'm about to describe doesn't spring on the people who were careless with money. It springs on the people who were careful, the ones who listened to every piece of advice, who maxed out their 401k for 30 years, who deferred and then deferred some more. The retirement tax trap is almost by design a trap for the diligent. So let's walk through exactly how it works, how it quietly doubles a tax bill, and what the one couple did to beat it. And stay with me to the end, because I'm going to show you the cruelest twist of all. What happens to the one who's left behind when the first spouse passes away? Most people have never heard of it. It's called the widow's penalty, and it can hit a grieving spouse with a bigger tax bill on less income. I'll also show you why these traps quietly catch more middle-class retirees every single year, almost on autopilot. So for your entire working life, the message was the same. Put money in your 401k before taxes, lower your taxable income today, and you'll pay the tax later in retirement, when supposedly you'll be in a lower bracket. For a lot of people, that was good advice. But it rested on one big assumption, that you'd be poorer in retirement than you were while working. And for the diligent saver, the person who actually followed the advice and built a 7-figure account, that assumption often turns out to be wrong. They're not poorer. Between a large pre-tax account, Social Security, and a paid-off house, they can land in the same bracket they were in while working, or a higher one. The result is a country sitting on trillions of dollars in pre-tax retirement accounts, money on which not 1 cent of tax has been paid yet, and the government has not forgotten. It is, in a very real sense, a silent partner in your 401k, patiently waiting to collect its share. The only question is whether you collect it on your terms or on theirs. And this is also why a lot of retirees start looking beyond just the usual paper assets inside a traditional retirement account. Because when your entire retirement is tied up in a 401k, IRA, stocks, bonds, and future tax rules, you're exposed to a lot of things you don't fully control: federal policy, inflation, market volatility, and whatever tax rules exist 10 or 20 years from now. That doesn't mean you should panic or move everything around. But it does mean it's worth understanding how some retirees use different kinds of assets to diversify part of their retirement savings outside the normal paper asset system. One such asset is real gold and silver that you can hold in your hands. There's this thing called a gold IRA that most Americans still don't know about. If you want to learn about it, I'll leave a link below to a free gold IRA information guide. Just click the link, fill in your information, and you'll get the guide delivered directly to your email. The guide explains how physical gold can be held inside a retirement account, how rollovers work, what the IRS rules are, and what you need to know before moving any retirement money. You don't have to buy anything. Just use it as a free educational guide so you can decide whether physical gold belongs anywhere in your retirement plan. Now back to Stan and Ron, because the key issue here is not just what you own, it's which tax bucket you own it in. But before we go further, let me explain something in plain English, because the whole video depends on you understanding this. There are two main kinds of retirement accounts. A traditional 401k or IRA is the tax me later bucket. You got a tax break when you put the money in, the money grows untouched, and you pay ordinary income tax on every dollar you pull out. A Roth account is the tax me never again bucket. You pay the tax up front, on the way in, and then it grows and comes out completely tax-free. Stan and Ron both have $1.2 million in the tax me later bucket. That's the whole story. What Ron is going to do, and Stan isn't, is quietly move money from the tax me later bucket to the tax me never bucket during the calm years before the storm. Hold that thought. For the math, I'll keep it simple and consistent. I'll assume that $1.2 million grows at about 6% a year. I'll assume the couple collects around $40,000 a year from Social Security. And I'll assume they don't really need to touch the big 401k in their early retirement because they've got other savings to live on for a while. Now, I know some of you will say 6% is too high, or too low, or that nobody's situation is this tidy. Fair enough. These are round numbers to show you how the gears turn, not a prediction about your life. The mechanics are what matter, and the mechanics are the same whether your number is half this or double it. Here's the first jaw of the trap, and most people genuinely don't see it coming. You cannot leave money in a traditional retirement account forever. At a certain age, the government forces you to start pulling it out, whether you need the money or not, so it can finally collect the taxes you deferred all those years. These forced withdrawals have a clunky name, required minimum distributions or RMDs, but the idea is simple. The IRS makes you empty the account on a schedule. For people retiring around now, that forced withdrawal age is 73 for those born between 1951 and 1959, and 75 for those born in 1960 or later. Stan and Ron were born in 1963, so their clock starts at 75. And if you ever skip a required withdrawal, the penalty is steep. 25% of the amount you should have taken, reduced to 10% if you fix it quickly. The government is not subtle about wanting its money. So let's follow Stan. He retires at 63, and like a lot of disciplined people, he leaves the big account alone. That's my nest egg, he thinks. I'll touch it last. He lives on his other savings and his Social Security, and he lets the $1.2 million ride. And it grows. At 6% a year, over the 12 years from 63 to 75, that $1.2 million becomes roughly $2.4 million. Stan's thrilled. Look at that number. Then he turns 75 and the letter arrives. His first required withdrawal is that $2.4 million divided by an IRS factor, and it comes to about $98,000 in 1 year, forced out, fully taxable, whether he needs it or not. Stan and Sue were comfortably living on maybe $60,000 or $70,000 a year. Now the government has just shoved $98,000 of income onto their tax return, on top of their Social Security, like it or not, and it gets worse every year, because the account is still large and the required percentage keeps climbing as they age. The nest egg Stan was so proud of growing has become a tax bomb, and at 75, the fuse runs out. Now the second jaw closes, and this one is sneaky, because it taxes money you already thought was yours. You may have heard that Social Security can be taxed. Whether it is, depends on something called your provisional income. Don't let the term scare you. It's basically all your other income plus half of your Social Security. The IRS adds that up and compares it to a couple of thresholds to decide how much of your Social Security check gets taxed. Here's the maddening part. For a married couple, once that provisional income passes $44,000, up to 85% of your Social Security benefits become taxable. And those thresholds were written into law back in 1983 and 1984 and were never adjusted for inflation. In 1984, $44,000 was a comfortable upper-middle-class income. Today, it's barely getting by, and yet the line hasn't moved an inch in 40 years. So watch what Stan's forced withdrawal does. His provisional income is now that $98,000 withdrawal, plus half his Social Security, well over $100,000. He's blown past the $44,000 line so far it's not even visible in the rearview mirror. So now 85% of his Social Security gets taxed too. $34,000 of benefits he thought were his, now sitting on the taxable line. This is what planners call the tax torpedo, and here's why it's so vicious. In the danger zone, every extra dollar you pull from a traditional account can make about 85 cents of your Social Security taxable too. So $1 of withdrawal creates $1.85 of taxable income. The effect is that a retiree who thinks they're in the 22% bracket can end up paying an effective rate north of 40% on those withdrawals. Stan never agreed to a 40% rate. The tax code handed it to him anyway, because his RMD dragged his Social Security into the fire with it. There's a third jaw, and it's the one almost nobody mentions until the bill shows up. When your income in retirement climbs high enough, the government quietly raises your Medicare premiums. It's a surcharge with another ugly name, IRMAA, but think of it as a tax on your Medicare, charged to higher income retirees. In 2026, the standard Medicare Part B premium is about $203 a month. But once a couple's income crosses $218,000, that premium climbs all the way up to nearly $690 a month per person at the top. Two things make it brutal. First, it's a cliff. Go $1 over a threshold, and the full surcharge kicks in. There's no easing into it. Second, it runs on a 2-year delay. Your premium this year is based on your income from 2 years ago. So a single big withdrawal today can quietly raise your healthcare costs years later, long after you've forgotten about it. Now, while Stan and Sue are both alive, their income, around $138,000, stays under that $218,000 couples line. So the surcharge doesn't grab them yet. Hold on to that, because it's about to matter enormously, because the surcharge for a single person kicks in at half that level. And someday, one of them will be single. So that's the trap, a forced withdrawal that detonates at 75, a torpedo that taxes your Social Security, and a surcharge waiting in the wings. Now let me show you what Ron did differently, because it wasn't dramatic and it wasn't a secret. It was just 12 quiet years of paying attention. Ron understood one thing Stan didn't. The years between retiring at 63 and that forced withdrawal age of 75 are the most valuable tax planning years of your entire life. For that stretch, your income is low, you're not working, and the government isn't forcing withdrawals yet. You're sitting in a low tax bracket, maybe the lowest you'll ever see again. That's not a time to hide from your 401k. That's a time to quietly drain it on your own terms. So every year, Ron did something called a Roth conversion. In plain English, he moved a chunk of money from the tax me later bucket into the tax me never bucket and paid the tax on it that year, on purpose. He'd look at where the low brackets ended, and he'd convert just enough to fill them up without spilling into the higher ones. Roughly $70,000 a year, year after year, paying tax at those low rates while he had the chance. It feels strange to volunteer to pay taxes, but Ron understood he was going to pay them eventually. The silent partner always collects. The only question was whether he'd pay at today's low, controlled rates or tomorrow's high, forced ones. Over those 12 years, Ron moved more than $800,000 into his Roth. So when he turns 75 and his own letter arrives, his remaining traditional account is far smaller, and his first forced withdrawal is about $47,000, not Stan's $98, roughly half, every year for the rest of his life. And the ripple effects are beautiful. With a smaller forced withdrawal, his provisional income stays lower, so far less of his Social Security gets caught in the torpedo. Money he pulls from that Roth bucket is completely tax-free and doesn't even count toward the income that taxes his Social Security or triggers the Medicare surcharge. And here's the cherry on top. Roth accounts have no required withdrawals during your lifetime at all. Ron's tax-free bucket can just sit there and grow untouched for as long as he likes. Same starting point, Same 1.2 million. One difference. Ron used the quiet years, and Stan let them slip by. So who comes out ahead? Stan, by doing nothing, lets his tax bill compound right alongside his account. He pays the deferred taxes all at once, late in life, at those torpedo-amplified rates, year after year, with no flexibility left. Ron paid his taxes early, deliberately, at low rates, and bought himself a tax-free bucket and a much smaller bomb. Run it over a full retirement, and the difference between these two identical couples isn't a rounding error. It's easily tens of thousands of dollars, and for larger accounts well into six figures. Not earned, not invested, just kept instead of handed over because one couple paid attention to the calendar. Now, the twist I promised. And I'll be honest, this is the part that bothers me most because it lands on someone at the worst possible moment. Let's say Stan passes away first, as husbands often do. Sue is grieving, and the following spring she sits down to do the taxes alone for the first time and gets a second shock on top of the first. Here's what happened. When Stan died, the household lost the smaller of their two Social Security checks. Sue keeps the larger one, but the total coming in drops, so her income went down. You'd think her taxes would go down too. They go up, sometimes way up. Why? Because now Sue files as a single person, and the single tax brackets are roughly half as wide as the married brackets, and the standard deduction, the chunk of income that's automatically tax-free, gets cut roughly in half too. Meanwhile, that forced withdrawal from the 401k is still nearly as enormous as ever. So Sue is now stuffing almost the same giant income through a much smaller set of brackets. Same money, far higher tax. That's the widow's penalty, and almost no one sees it coming. And remember that Medicare surcharge that didn't touch them as a couple? Sue, now single, crosses the single threshold. So on top of everything else, her Medicare premiums jump too, in the same year she buried her husband. This is where Ron's quiet dozen years pay their richest dividend. Because he shrank the forced withdrawals and built that tax-free Roth bucket, when he passes, Rita is left with a small, manageable tax bill and a pile of money she can draw on tax-free. He didn't just save himself money, he protected the person he was going to leave behind. That, to me, is the whole point. Now let me be fair, because this is not a story about Roth good, traditional bad. That would be too simple, and you deserve better. Deferring taxes during your career was not a mistake. That upfront tax break was real, and for decades it let your money grow that the government would otherwise have taken. Plenty of people genuinely do drop into a lower bracket in retirement, and for them, the trap never springs. They were right to defer, and they're fine. And the fix isn't free. When you do a Roth conversion, you have to pay the tax that year, which means you need cash on hand to pay it. Ideally from outside the retirement account. Convert too much and you can shove yourself right into the higher brackets or over that Medicare cliff and cause the very problem you're trying to avoid. If you're going to give a big chunk to charity anyway, there are ways to satisfy those forced withdrawals tax-free instead. If tax rates somehow fall in the future, or you don't live as long as you planned, paying early can even backfire. In other words, this is a real trap, but it's not everyone's trap, and the escape route has to be measured carefully. Everyone's situation is different. The goal isn't to panic, it's to look. So, if you're sitting there wondering whether this is you, here's a simple framework. No spreadsheet required, just an honest look at a handful of things. First, how big is your pre-tax pile? If most of your savings is in traditional 401ks and IRAs and it's well into the 6 or 7 figures, you're a candidate for this trap. If it's modest, you can probably relax. Second, look at the window. Count the years between when you retire and when those forced withdrawals begin, your early 60s to age 73 or 75. Those low-income years are your runway. The longer it is, the more you can quietly defuse. Third, compare your bracket now to your bracket later. If you expect your income to jump when the forced withdrawals start, that gap is your opportunity to convert in between. Fourth, think about which spouse is likely to outlive the other and what that survivor's tax picture looks like alone. That's the widow's penalty, and planning for it is one of the kindest things you can do. Fifth, and this one has a deadline. There's a temporary tax break right now. For tax years 2025 through 2028, Americans 65 and older get an extra $6,000 deduction per person, $12,000 for a couple where both qualify, though it phases out at higher incomes and is scheduled to disappear after 2028. That's a 4-year window where conversions may be a little cheaper. Just know it doesn't change how your Social Security is taxed or how the Medicare surcharge is figured. It's helpful, but it's not a force field. And finally, run the numbers before you act, ideally with a tax professional. A few hours of planning in your 60s can be worth tens of thousands of dollars over your retirement. This is genuinely a place where looking before you leap pays for itself many times over. Let me zoom out, because the part that I promised, why this quietly catches more people every year, is really a story about the rules themselves. The government is a silent partner in every pre-tax retirement account in this country, and it has been waiting decades to collect. That was always the deal. What's changed is the math around it. Today's tax rates are historically low, and in 2025, a new law made those lower rates and the bigger standard deduction permanent, which is why the old warning that rates jump back up next year no longer applies. But permanent in tax law just means until Congress changes it again, and with the national debt where it is, betting that your future rates will be lower than today's is, at best, a bet. Meanwhile, the traps quietly widen on autopilot. The income lines that tax your Social Security have been frozen since the 1980s. They don't rise with inflation, so every year, as prices and benefits creep up, a few more middle-class retirees who were never the intended target get pulled across them. The brackets that the surviving spouse falls into don't adjust for grief. And the temporary breaks, like that senior deduction, are written to expire. None of this is a conspiracy. It's just a system that quietly favors the retiree who's paying attention and quietly penalizes the one who assumes it'll all work out. So here's where Stan and Ron leave us. They started in exactly the same place, same age, same nest egg, same good intentions. The only thing that separated them was that one of them treated the quiet years before 75 as the most important tax planning years of his life, and the other treated them as a victory lap. The trap nobody warns you about isn't really about Roth accounts or required withdrawals or any single rule. It's about a simple truth. The taxes on a lifetime of diligent saving don't disappear. They just wait. You can pay them on your terms, in the calm years, at rates you choose. Or you can let them wait for you and pay them on the government's terms, all at once, late in life, with your spouse left holding the bill. Look at your own numbers while the quiet years are still in front of you, because that's the window where almost all of this gets decided.